Hey everyone, and welcome to the Crypto Pump channel. Here, we make crypto simple and help you earn with confidence, while avoiding unnecessary risks. Today, you're in for a full-on guide to one of the most exciting topics in trading. In this episode, we're diving deep into futures trading on Bybit, a powerful tool that lets you profit from both rising and falling markets, with leverage up to 100x. You'll learn how to open long and short positions, use different order types, set stop losses and trailing stops to manage your risk like a pro. We'll also break down how leverage can boost your profits, but why it also demands caution due to the risk of liquidation. This is a complete walkthrough with real examples and practical tips for anyone who wants to trade smart and stay in control. Want to go even deeper into futures and get proven trading strategies? Then make sure to join our Telegram channel. You'll find fresh guides, insights from experienced traders, and an active chat where you can ask questions and learn together. The link's in the description. Come join us, it's worth it. What are futures and how do they work? Futures on Bybit aren't about buying cryptocurrency directly. They're contracts with the exchange where you're making a prediction about price movement. Imagine agreeing to buy Bitcoin at today's price sometime in the future. If the price goes up, you earn the difference. You don't need to own the coin. You're trading a contract that pays off if your forecast is right. Futures originally came from agriculture. Farmers would lock in prices for their crops ahead of time. For example, a farmer might agree to sell wheat at a fixed price by fall. Even if the market price changed, the deal stayed the same. In crypto, the idea is similar, but instead of physical goods, you're speculating on digital assets. You don't hold the asset itself. You're betting on its price direction. Bybit futures let you react quickly to the market. You're not buying crypto and waiting for it to rise. Instead, you enter a contract. If your prediction is correct, you profit. If not, you only lose what you put in. Say you believe Bitcoin will go up. You open a long, and if the price rises, you lock in gains. Or maybe you expect a drop. You borrow Bitcoin from the exchange, sell it, then buy it back cheaper and keep the difference. This isn't traditional trading where you hold coins in a wallet. You're not owning the asset, you're trading its movement. That's why futures are often called trading air. There's nothing in your hands, just a contract and a settlement with the exchange. What about you? What's your experience with futures? Drop a comment below. We'd love to hear who's already in profit and who's just getting started. Let's find out if it's really true that 90% of traders lose their deposits, or if the reality is more nuanced. Long and short, how to earn on price changes. In Bybit futures trading, there are two main directions, long and short. A long position is a bet that the price will rise. You open a trade expecting Bitcoin's price to go up. If your prediction is correct and the price increases, you close the position and earn the difference between your entry and exit. It's similar to the classic buy low, sell high strategy. Except here, you're not holding the asset in a wallet. Everything happens through a contract. A short position is a bet that the price will fall. You borrow Bitcoin from the exchange, sell it at the current price, and then, when the price drops, buy it back cheaper and return it. The difference between the selling price and the repurchase price is your profit. For example, you borrow Bitcoin, sell it, wait for the price to drop, buy it back, and return it to the exchange. The leftover is your gain. This approach allows you to profit even in a falling market, which isn't possible with regular spot trading. Futures stand out from simply buying crypto because they let you earn in both directions, up or down. In spot trading, you buy a coin and wait for it to rise. With futures, if you believe the market will drop, you can open a short and profit from the decline. This makes futures a flexible tool. You're not stuck waiting for bullish trends and can stay active even during downturns. But keep in mind, shorting is riskier than going long. A price can rise indefinitely, but it can only fall to zero. If the market suddenly turns upward, losses on a short can exceed your expectations. That's why shorting requires extra caution and a solid understanding of market dynamics. Let's break down the next stage. How to start trading futures on Bybit. When you're ready to start trading futures, Bybit is a great platform to begin with. It's designed for quick, responsive trading, perfect for short-term positions and fast market moves. To get started, head to the derivatives section on the Bybit website or app. That's where you'll find all the tools for futures trading and opening contracts. Next, choose the contract type. Perpetual USDT. This is one of the most popular options because it's tied to the stablecoin USDT and doesn't have an expiration date. Then, select your trading pair. For example, BTC USDT, which means you're trading Bitcoin against USDT. Once you choose the pair, the trading terminal will open, and you're ready to go. Before opening a position, you'll need to transfer funds to your futures account. Bybit has a main wallet where your assets are stored. From there, you can send the desired amount, say in USDT, to your futures wallet. It only takes a few clicks. Go to the Assets section, select Transfer, enter the amount, and confirm. Once the funds arrive, you're all set to trade. Why choose Bybit? Because the interface is user-friendly, the terminal is flexible, and all the key features are right at your fingertips. You can easily open a long or short position, set stop loss, and take profit orders. More on that later. It's a great platform for managing risk and is beginner-friendly too. And if you register using my referral link, you can get up to $30,000 in bonuses, a great boost to get started. The link is in the description. Don't miss your chance to start with an edge. And so, the next stage is leverage, how it increases both profit and risk. Leverage in Bybit futures trading is a tool that allows you to trade with more capital than you actually have. Imagine you have $1,000 and choose 10x leverage. The exchange adds $9,000, letting you open a position worth $10,000. Now, every price movement affects the full $10,000, not just your own funds. If you open a long position with this leverage, you're betting on the price going up. Let's say Bitcoin starts rising. A 10% increase in price would earn you $1,000. That's a 100% return on your deposit, because your profit is calculated from the full position size. Without leverage, you'd only make $100. Leverage amplifies your gains, which makes it a powerful tool for active traders. But remember, leverage also magnifies losses. In the same example, if the price drops by 12%, your position would be liquidated. The exchange would automatically close it to prevent losses beyond your deposit. You'd lose the entire $1,000 because there wouldn't be enough margin to keep the trade open. That's why risk management is absolutely essential when using leverage. Without understanding how liquidation works, you can lose your entire balance very quickly. For beginners, it's better to start with lower leverage, like 3x or 5x, to limit potential losses if the market moves against you. Bybit also offers a helpful tool, the liquidation calculator. It shows you the exact price at which your position would be closed. This helps you assess risk in advance and make more informed trading decisions. Now let's break down what margin is, how it affects your trading. Margin in Bybit futures trading is the amount you put up as collateral to open a position. When you use leverage, the exchange provides additional funds, but a portion of the capital, your margin, must be in your account as security. There are two types of margin, isolated and cross, and your choice determines how risk is managed. Isolated margin means you're only risking the amount allocated to that specific trade. For example, if you have $10,000 in your account and open a position with $1,000 in margin, then even if the market moves against you and the position is liquidated, you'll only lose that $1,000. The remaining $9,000 stays untouched. This is a safer option for those who want to limit losses to a single trade. Cross margin works differently. Your entire available balance is used to support the open position. Let's say you again have $10,000 and open a trade with $1,000 margin. If the market moves against you, the system can draw from the remaining $9,000 to keep the position open. In the case of a sharp move, you risk losing your entire balance. That makes cross margin more aggressive and potentially more dangerous. For beginners, isolated margin is the better choice. It helps you control losses and protects the rest of your funds from one bad trade. Cross margin requires more experience and a solid understanding of market behavior. Choosing the right margin mode is a key step in managing risk and preserving your capital. Next, we come to a very important point without which you won't be able to earn consistently, and that is risk management. Risk management in Bybit futures trading is a skill you simply can't trade without. It helps you manage your positions in a way that protects your capital, especially when using leverage or trading with large amounts. This isn't just a helpful feature, it's the foundation of consistent trading. Without it, a couple of bad trades can wipe out your account. When you're trading futures, you're putting real money on the line. Without a clear understanding of risk, one mistake can lead to full liquidation. This is especially true when using 10x leverage or trading with cross margin, where losses can escalate quickly. Risk management allows you to define in advance how much you're willing to lose and helps you protect your funds, so you can keep trading even after setbacks. Bybit offers tools to help you manage risk effectively. You can use stop-loss orders, which we'll cover later in this video, to limit losses, or choose an isolated margin to ensure you're only risking a portion of your funds. The key is to take your time and learn the basics of capital management. Want to learn how to protect your funds and trade with confidence? Join our Telegram channel. You'll find practical tips, strategies, and support from fellow traders. The link is in the description. Come join us. Next, let's talk about the market and limit orders, what they are and how to use them. Market and limit orders on Bybit are the two main ways to enter a trade when trading futures. They let you choose between execution speed and entry precision. Each is suited to different situations, and it's important to understand how to use them to trade effectively. Let's start with the market order. This is the fastest way to open a position. You enter the trade at the current market price. You simply specify the amount, for example, 0.1 BTC, and click the button. The order is filled instantly. There's a small fee, roughly around $3. But in return, you don't miss the moment, especially when the market is moving fast. It's ideal when speed matters. You get into a long or short position right away at the current price. Now, the limit order. Here, you set the price at which you want to enter the market and wait for the price to reach that level. For example, if you want to buy Bitcoin at a lower price than it is now, you place a limit order, and it will only execute once the market hits your target. This gives you more control, but there's a chance the trade won't open if the price never reaches your level. This method suits traders who aren't in a rush and want a more precise entry. You can also customize your order settings. Specify the amount in BTC, for example 0.1, the total in dollars, say $1,000, or set the margin, and the system will automatically calculate how much of the asset you'll receive. This makes trading on Bybit flexible and convenient for both beginners and experienced traders. Finally, let's talk about stop loss and take profit and why they are important. Stop loss and take profit are essential tools for managing positions in futures trading. They allow you to set predefined levels where you're willing to lock in a loss or secure a profit, so the market doesn't catch you off guard. This is a core part of risk management, especially if you can't monitor the charts 24/7. A stop loss is a protective order that automatically closes your trade if the price moves against you. You set a level in advance where you're ready to exit the position. For example, you open a long position, but the market starts dropping. Once the price hits your stop level, the trade closes, and you only lose the amount you were prepared to risk. This helps preserve your capital and avoid major losses. A take profit, on the other hand, locks in your gains when the price reaches your target. You define the level where you want to exit with profit. As soon as the market hits that point, the position closes automatically. Let's say your trade is in profit and the price reaches your goal. The take profit triggers and secures your earnings before the market can reverse. You can set these orders when opening a trade or add them later. For example, you enter a long position, the market moves in your favor. You then place a stop loss just below your entry and a take profit above. This way, you stay in control. Losses are limited and profits are captured on time. It makes trading more structured and less stressful, especially if you're just starting out. What is a trailing stop and why is it needed? A trailing stop is a smart order that helps you lock in profits as the market moves in your favor. Unlike a regular stop loss, it doesn't stay fixed. A trailing stop follows the price, automatically adjusting as it rises. This is especially useful when your trade is already in profit, but you don't want to lose gains due to a sudden reversal. Here's how it works. Let's say you open a long position and set a trailing stop with a 3% offset. As the price climbs, the stop moves up with it, always staying 3% below the highest price reached. If the market then drops by that 3%, the order triggers and your position closes, locking in your profit before the market can take it back. Imagine you're in a long trade and the price keeps rising. The trailing stop moves up with each new high. If the price then falls by the set percentage, the position closes automatically. You don't lose all your gains, you keep most of the profit. This is especially valuable in futures trading, where volatility is high and reversals can be sharp. A trailing stop gives your trade room to grow while keeping risk under control. It works in the background and saves you from manually adjusting your stop loss every time the price moves. It's a great tool for traders who want to secure profits without cutting off the potential for further upside. What are conditional orders? How to trade based on market signals. A conditional order is a way to automatically enter a trade when the price reaches a level you've set. It only activates when specific conditions are met, so you don't have to watch the charts around the clock. It's a great tool for traders who want to catch the right moment without constant monitoring. Here's how it works. You set a trigger price, the level at which the order will activate. For example, if you're expecting a breakout to the upside, you place a conditional buy order. As soon as the price hits your trigger, the position opens automatically. Or if you're anticipating a drop, you can place a conditional short. Once the price falls to your trigger level, the order executes and you enter the market. These orders make trading more precise and convenient. You can plan your entry in advance based on your strategy and avoid missing opportunities if the market moves quickly. This is especially useful in futures trading, where price action can be fast and timing is critical. Conditional orders combine automation and control, allowing you to act with precision, without the stress of constant screen time. For those of you who made it almost to the end, here's a bonus. Let's break down a few extra tools that can take your trading to the next level. First tool, adding margin. If your position is close to liquidation, you can add more funds to push that critical level further away. Let's say you started with $500, but the market moved against you. By adding another $500, your total margin becomes $1,000. This shifts the liquidation price and gives your trade more breathing room, possibly enough for the market to reverse in your favor. Second tool, multiple take profits. Instead of setting just one profit target, you can place several. For example, you open a long and want to lock in gains gradually. The first take profit closes 1/3 of the position, the second closes another third, and the rest stays open in case the price keeps rising. This strategy lets you secure profits early while still leaving room for bigger moves. You're essentially splitting your trade into parts and exiting step by step, smart and strategic. Third tool, automation. Bybit offers a futures grid bot that automatically opens and closes trades based on a preset price grid, profiting from market fluctuations. There's also copy trading. You choose a professional trader, connect to their strategy, and automatically mirror their trades. It's a great way to learn by doing and earn alongside experienced market participants. Friends, now you know how to approach futures trading the smart way. Want even more helpful tips, market analysis, strategies, and real-world examples? Then be sure to check out our Telegram. The link is waiting for you in the description. If you found this video useful, don't forget to hit the like button, share it with your friends, and drop a comment below. Let us know what you found most interesting or what you'd like us to cover in future episodes. See you in the next videos. We've got plenty more insights, strategies, and deep dives coming your way.